Hey, welcome to the live stream. We will get started in just a few minutes. In the meantime, enjoy the background music. Hey, welcome to the live stream. Let's see what the market's doing today and see if there's any opportunities to get into some stocks. To evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. But I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable ones, all produce high free cash flow. High free cash flow. That's why I'm looking for high free cash flow. All the best investors depended on free cash flow and evaluating a company's ability to generate free cash flow. A company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks have taken the show, but are big cap stocks gonna come back? Chinese stocks are exploding. The dragon has awakened in China. And could be the best trade we've seen in a while. AI hype is really interesting. AI is going to be interesting in the future, but is it really a business today? I'm going to pass on this stock. Just not enough discount, and I'm not really believing that they're going to grow as well as they should. Options can make your performance go a little higher every month and generate nice income. Listen to the great super investors. They are pretty generous with their knowledge and their wisdom. You just got to read their books and listen to their videos. Learn something new every month. In investing, you'll become a great investor. You'll build wealth. This is a buy stock. You're looking at a discounted stock, and it's unappreciated at this time. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. Bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor and you will build great wealth. Hey, everybody. Hopefully you are enjoying a nice weekend. It's not over yet here in the U.S. There's still a nice evening to go. Maybe you're going to have a nice dinner, or maybe you're just getting ready for the week. In any event, thank you for joining me. And thanks for everybody who's on. Thank you for the comment, Genetic Smite. The intro, that song was recorded about 6 or 8 months ago, and I use it every once in a while, maybe to just get things going. Seems to be played on the weekends. It looks like Blocks for Fun is on. Hopefully you're having a nice day. And if you guys want to see stocks, please let me know. Let me know which stock you'd like me to take a look at. Just put it in the chat. If you're new to the channel, would like me to look at a stock, I'd be happy to do so. Just a $5 super chat, or join the channel. And then you can put stocks that you'd like to talk about in the chat. So I think everybody knows that on Friday we had a big sell-off day for some of the most valuable companies on the exchange. And I think what a question that's on everyone's mind is, how are stocks going to trade this week? Are they going to go higher? Are they going to go lower? And it's we'll see how this storyline on tariffs goes. our president is saying that, hey, it's not going to be a big deal. He's feels that stocks should be fine, and I think over the long haul, I completely agree. But in the near term, we'll see how far this stock market's going to drop. If we look at where it went in the March timeframe, it had a pretty good drop. And we'll go to the year to date. From the top to the bottom it went down 19% on the S&P. And it was really quick too. It was less than a month, and we had just a big drop in stock prices. And I think I don't know that we're going to go 19 on the S&P. Let me see what the NASDAQ did during that time. So back then we went down almost 24% on the NASDAQ. So am I seeing that kind of price action to the downside from the stock market? I don't see it, because I think on the last occasion, the leadership of the U.S. saw that, hey, this is really tanking the market. This could really get ugly and get out of control. And they put the tariffs on delay. Like, hey, we're not gonna do that just yet. Although they did charge quite a bit of tariffs, that the money was collected by the U.S. government. And since then, boy, the market's really gone up. On the NASDAQ's up 45% since we hit the very bottom. And the NASDAQ over one day, it lost 3.5%. So you could see that the velocity of the sell-off is quite fast. If we don't get clear direction on tariffs, the market's going to behave the way it should, which is, hey, 100% tariff on Chinese goods is very disruptive. When I go to Costco, just my best guess is at least 60% of the stuff in there, it's coming from China. Might even be as high as 70% of the stuff. If I go into a Target, ditto. 70% of the stuff's coming from China. And you go to Walmart, you go on Amazon. So 100% tariff would be a huge burden on the consumer, an additional, tax on consumption. And I think it would really slow down the consumption of goods. So I think that's where we're going to be until we get a clear plan of how, I guess, the Chinese and the U.S. government are going to form an agreement on tariffs. Maybe something that the U.S. president and the leader of China meet and kind of agree on something that we could hang our hat on for the next couple of years. That's what I would really like to see. That way we don't have a market that's going to be moving up and down on the news lines. Now, leading into Friday's sell-off, I was already of the mind that we were dealing with an expensive market, and an expensive market that didn't need a lot of reasons to probably sell off. And I happen to believe that, if everything's prediction markets these days, right? And I should take a look at where the prediction markets have the length of the tariff war. And we'll look at that during the stream, because that'd be interesting. And my expectation is, if for this coming week, if we don't have clear kind of direction on tariffs, I think we're going to be down at the end of the week. I don't know if we'll be down like 1%, 5%, but it's going to be between one or the other. And I think it could really begin to create what I think is a productive exercise of selling off stocks and kind of getting some of these prices back down. So my feeling before the whole tariff scare on Friday was we have an expensive market, and can it continue to go higher? Yeah, it could. Absolutely. But it just makes it less and less comfortable as it goes higher. Looks like Cartel Raider is in. Good to see you. All right, so let me look up and ask Gemini. See if Gemini can help me out. How long is this thing going to happen here? So there was that truce. Oh, no big news there. All right. So we'll see if we get through the week without any news on the tariff front. But my feeling is if we don't have clear direction on tariffs, I think stocks are going to continue to sell off. Now, stocks are rallying on the tweet that, hey, everything's going to be okay. But I think it might be a little bit premature, because I could totally see this being a head fake. And the head fake being we open up higher, investors that want out are going to sell their shares, and then it's going to drive the market down. That'll be even scarier that we opened up green and then went red, and that'll drive the market into a nice sell-off for the week. Again, those are just guesses on my part. I don't pretend to know how to predict how the market's going to behave. I'm just looking at it and seeing the situation that we found ourselves in March and in April, and saying it's probably going to resemble what we experienced back there, that the market sold off quite harshly. And it really presented opportunities for some stocks that are terrific businesses, and it presented opportunities to buy those stocks at a really good price. All right, so that's where we're at. It is Sunday before the market opens. I thought I'd have a little fun on this stream. I did look at what stocks are trending, and no big surprise, the big stocks that are trending are Nvidia, Amazon, AMD, which has had a really interesting couple of weeks, Tesla, Palantir. But in addition to those, there was like 3 stocks that I'm really not familiar with. They really went up a lot. These are probably tiny caps that went up a lot. So we can take a look at these stocks and see how they behaved on Friday and see what they're telling us on a Sunday night. So again, all the members, if you guys want me to look at a stock, put it in the chat. I'll take a look. But for now, let's take a look at Nvidia, see what that's doing. All right, so Nvidia incredibly has added so much market cap this year. It has gone up 36%. So that's more than $1 trillion of market cap. $1 trillion. That's a lot of market cap. And over the 1 year, it's doing fantastic. Over the 5-year, incredible. Now, this stock really sold off when we had the first tariff scare. It went from $147 a share, and it got down to the 80s. So if we stay in this tariff scare, we will see really good stocks sell off. If we stay in it for 2, 3, 4 weeks, maybe Nvidia might hit, I don't know, $140 a share. Everything's going to get discounted, right? All the top 10 most valuable businesses, they will all see their stocks come down without exception. The only stocks that will advance are safe stocks like consumer staple stocks, maybe some utilities. Those will go up. Maybe even the telcos like AT&T, Verizon, T-Mobile. But most stocks will come down if there's a big scare that, hey, these tariffs could really impact the economy. It could slow things down. And then we get into a good solid recession. Then everybody's going to have to restate their numbers and restate their profits. Also, Nvidia, if we think about the big conflict between US and China, the conflict that I've heard is that China controls rare earth materials, and these rare earth materials are needed in a lot of different industries for the US, automotive, all kinds of equipment that's made for the military. Just it's really important. And for some reason, just China controls a lot of the rare earths. And China's negotiating to get more of the technology that's made in the US into China. So chips and software. And the US is not liking that idea because they don't want to turn over, the great technology that US companies have. So that's the big negotiation is, hey, we want the rare earths. They want our technology. How are they going to solve that? That's why they wanted to be elected. They got elected. They'll have to figure that out. We'll see how it goes. And Meredith, good to see you. You want to take a look at Nebius? I'd be happy to look at Nebius. But let's stay on Nvidia, and then we're going to move over to Nebius right after Nvidia. So these guys, analysts still think it's a strong buy, and it's discounted by 13%. And I kind of laugh because I'm like, wow, after a business going up to 4.45 trillion, 13% on that number is roughly $500 billion of market cap. So analysts think we got to add $5 billion of market cap, taking Nvidia up to $5 trillion of market cap. Whew, that is one valuable company for sure. Now, these guys have an earnings that is later in the year, November 19th. So we are about a month and a week from Nvidia announcing, but we're around the corner from some of the other businesses like Microsoft and Alphabet, Google, and others reporting. They're going to report over the next couple of weeks. So we're going to see what they're doing and how much money they intend on spending on CapEx specific to the data center. And then on the 19th of November, right before Thanksgiving, we will hear from Nvidia. These guys did sell off almost 5% on Friday, trading flat right now, but too early to tell if this stock's going to go up or down. The fundamentals look really good on Nvidia. Their growth has been superb. Their profitability is superb. And they're really experiencing kind of a once in a lifetime situation. Their gross margins are 70%. The profit margin is 52%. Free cash flow margins are 43%. So they're just raking in so much money. Now, I happen to believe that semiconductors are cyclical. You're going to have a growth period and then a contraction period. And a lot of people believe, hey, this data center build out is going to last for a while. We'll see. It's hard to believe that corporations are going to spend the kind of money they've been spending for a long time. It's a lot of money. So we'll see. We'll see if things begin to slow down or if they're just going to stay at the brisk pace that we've seen. We'll get a bird's eye view into that as we see companies that are going to be announcing, again, Microsoft, Amazon, Google, Alphabet. Those are the three big hyperscaler businesses. We're going to look at Nebius, but Nebius is small compared to those three giants. And I'll point that out when we look at Nebius. I'll I'll point out what their revenue is and then what the revenue is for Amazon and Microsoft Azure and Google Cloud. And you'll see that, man, Nebius is tiny compared to those guys. That'll be interesting. All right. So moving on from there, let's look at the forecast. We've got 42 analysts. There is some disagreement on where the stock ought to be priced. We have some analysts saying $300 a share, which would be a nice rise from this point. We have some analysts saying $100 a share, which would be a big drop for Nvidia. 13% discount. Okay. Let's look at their forecast. The forecast, and this is expecting that data center is going to continue to just companies, the big ones, the OpenAIs, Meta, Google Cloud, Microsoft Azure, AWS are going to continue to buy these GPUs from Nvidia, and they're going to grow. These guys have a unusual fiscal year that ends January 26th. So we're already in fiscal year 26 that will end January 26th. And this is the year that we're in. Next year, they're going to grow 33.8% and then kind of come back down to 16 and then down to 9. So how will investors view this type of growth? I think for now, they're fine because in looking at Apple, I thought Apple would certainly see big price decreases because they were not growing and they didn't grow for like 3 years. But the market really held up the Apple stock quite well. They were just like, hey, it's Apple. They've been so good for so long. We believe they're going to just figure this thing out. And they haven't. They continue to not grow. So I think it's going to be the same thing with Nvidia. People will be like, hey, I'm holding my Nvidia stock. And the stock price will probably do okay, even though the company may begin to slow down on their sales or revenue growth. So we'll see when we get there. Their profitability is going to slow down as well. And unless the stock price goes up, the PE ratio, and it looks like this is the year we're in, it's going to be 39, call it 40. And then next year, that begins January 26, 2027, is going to be at PE of 28, falling to 24, and then 22, unless the stock price goes up. So that's where Nvidia is at. So that's what the outside world is thinking. Let me tell you what I'm thinking on Nvidia. And Nvidia has been one that, I need to be transparent. And, there's a lot of stocks that I've gotten right. And there's this one that I got wrong. I have not been able to forecast this business well enough. And it's really, it's a shame that I didn't invest in Nvidia. I did invest in other semiconductors during the last 3 years, and I've made money, like Broadcom, Astera Labs, ASML. But this one here, I continue to think the stock price just priced too high. And I am surprised as to how much capital the data centers are receiving. It's been really, really incredible. And I've been surprised by it. And but my research giving Nvidia a very, very good optimistic forecast of cash flows they're going to produce, discounting those cash flows to today's value. I get a 41% premium on Nvidia stock. So earnings per share does reveal that, hey, it's priced fairly if you just focus on earnings per share. But I focus primarily on the value of cash flows. That's what the books tell you to do. That's what these long-term successful investors have done. They focus on cash flows and discounting those cash flows to today's value. So overall, I think Nvidia is priced 26% too high. We will see. This will be incredibly interesting to follow. I will be following it and reporting to you what I'm seeing. So that is Nvidia. We're going to move to Nebius, and This is another data center company. Now, before I do that, blocks for fun. I have your stock on the list. That's SSTK. Very good to see you. So Nebius is a full stack infrastructure service company. It's a data center company. In their history, they were once a cyber crypto miner that has retooled and now focuses on providing services for companies that want to build out large language models, AI, and they're out of Europe. I believe they're headquartered in the Netherlands. So interesting business. They are experiencing some growth, but we'll look at their financials. They're seeing a stock price just really take off. It's a $32 billion market cap company, and they are probably comparable to CoreWeave. CoreWeave is a stock that's really gone up as well. Those are pure play data center stocks. The companies like Amazon with AWS, it has a more diversified business, and but it is the biggest one. And I'm going to compare the total revenue of Nebius versus AWS, Microsoft Azure, and Google Cloud in a minute. All right, so we have $32 billion. Revenue is $249 million. Okay, so $249 million. Remember that number. We'll look at it later. PE is really high, 152 PE. And analysts believe it's priced a little too high. Looking at their financials, remember how I said they used to do something else? They realized, hey, AI is what's really cool and exciting. And they switched. And now they're like, hey, we're an AI company. Okay, cool. So the market's like buying their services, renting out their GPUs, looking at their infrastructure. So it's a business that kind of switched, given the opportunity to build that out. Now that is a little risky because they don't have a lot of experience running high performance data centers for the purpose of development. They had previously been in control of doing their crypto mining, which is different, right? When you develop on a public cloud like this, you're developing a large language model or an application. And I think it takes some know-how. So there may be some setbacks and additional costs that are going to be incurred. But so far, 249 million, of revenue. So it's not a very big company. And they are not operating profitably. They have revenue 249, cost of revenue, which is, what did it cost to run all that infrastructure and provide the service? 115. So that's about a 50 some odd % margin. We'll look at that in a little bit. They have selling, general, and administrative costs, which are even higher than the revenue. So they got to grow in order for them to become profitable. They have some R&D. Again, takes some know-how to run high-performance data centers. It's not just, hey, we're going to run a couple servers for a customer. No. These GPUs, you have to create the superclusters properly in order for them to be efficient. They consume a lot of power. They create a lot of heat. There's a lot to it. And it looks like they're spending a lot of money in research and development, trying to get the right process and knowledge to run these high performance data centers. So overall, they're losing money. They're not making money. They're losing money. When we look at their, and this is interesting. So they have unusual items which were included here. When you exclude them, okay. So before you include unusual items, and it looks like they sold some assets. They probably sold some Bitcoin or something, and they created a net profit. But it's not of their normal operations. So that's why it's excluded, because we shouldn't expect that to happen over and over again. And that did create a gain. All right. Their shares outstanding have kind of been all over the place, but the good news is that the number of shares outstanding have gone down. So they either bought back shares, maybe when they collapsed the crypto operations, they sold all the Bitcoin and bought back shares. So they're not generating free cash flow. They're actually burning cash, 2.1 billion of cash in the trailing 12 months. Gross margins are 53%. Now they had that unusual item, so they have profit there. But as we saw from operating income, it didn't look all that great. The operating margin, they're actually losing a lot of money. So unless they have like endless supplies of Bitcoins to sell or assets to sell at a profit, they will soon be operating with big losses. So this is a business. It's relatively small, losing money. Balance sheet, I think, is good. Let's take a look. I always wanted to look at the balance sheet because I want to make sure that we're dealing with a good quality business. In this case, we are. This company has more cash than it does debt. All right. One of the things, just from a comparability standpoint, I wanted to show you is, so these guys are $249 million of revenue, and their market cap is 32 billion. So they're not even $1 billion in revenue. So let's just say, in order to get to $1 billion of revenue, the equivalent market cap, you'd have to multiply it times 4. Okay. And that would mean that you're at 128 billion. You're paying $128 billion market cap to buy $1 billion of revenue from this hyperscaler. Well, let me show you where AWS and all these big hyperscalers are at, because I think it'd be interesting to just compare and see, well, you know, if I was interested in buying into the data center play. Now, I'm going to put Nebius here. First, I got to take my cap locks off. So AWS, this is 123 billion. These guys are 249 million. Okay, see how they're way down. They're not very big, and they wouldn't even measure on the market share. But I think one of the rankings I had was, let's go 1 billion of revenue. And you know what? I'd probably be better off putting it as an additional column. So these guys, it's so it's basically for $1 billion of revenue, for market cap. So the market cap for $1 billion of revenue, 996 billion. But these guys, they have a market cap of 2.3 trillion. So, and these guys have a e-commerce business as well. So I'm going to say that you get $123 billion of revenue, same type of industry, and you're getting it for 2.3 trillion, and you get the number one leading e-commerce business. So you're actually getting it for a fraction of that. Let's say half of it, actually it'd be more than that, more like 70% of the value of Amazon is from this AWS business. So in order to calculate that, so we have this number divided by this number. And I think I'm going to have to do some more math on that. So here we need 18 billion of market cap. I think I'm going to need to work on that on my own because I'm not quite making sense on that. The point that I wanted to make is that Nebius, CoreWeave, and these other companies are really small compared to these big giants. And I happen to believe that as the economy within these hyperscalers goes, businesses are going to be more inclined with just doing business with one of these big guys. It's like AT&T, Verizon, T-Mobile. Everybody knows that, hey, if I get a plan with these guys, especially a business, right? If you're going to get phones for all your employees, you're going to go with one of these big guys because you know the service is going to work. These smaller players, I think, are going to be used by maybe the smaller companies, maybe the startups. And that business may not be as consistent as the business coming from AWS or Microsoft or Google Cloud. So that's one of the concerns that I have when I look at a Nebius is, will they ever grow to be substantial size? If they do, how are they going to grow against these three giants? And then there's others that are really big but aren't being listed here. So that's one of the concerns I have on Nebius. Now, let me see if I have a valuation on Nebius. Oh, I don't. So, and the reason I don't have one is they don't generate positive free cash flow. And it's very hard to value a business that doesn't have cash flow. It's just really pie in the sky. Hey, is it going to be worth that much in the future? So I don't have a valuation for them because I just can't get there with a negative free cash flow number. The PE is really high for them. And we'll see where these goes. We'll see. They didn't have much of a sell-off on Friday. I would say that much. Compared to others, right? You have like Nvidia went down 5%. Nebius was only down 2.31. In the after hours, it's down 2%, but who knows? I think we need to let the market open tomorrow, let it trade for the hours that it trades, and then we'll see what it's doing. I'm focused on the whole week next week, and we'll see where stocks trade. The whole week will tell us, is the market scared or is the market going to hang in there? So Nebius is, in my opinion, really high risk. I think it's priced quite optimistically. Those who got in are probably feeling like, man, I made so much money on this. But the foundation of this company is risky, to say the least. If you look at how many losses, is it sustainable? Who's going to be their competition if they want to be bigger? Well, you got some big giant companies you're going to compete against. So I am not an investor in Nebius, but wanted to cover it. And those are my comments there, Meredith. Thanks for asking. So we're going to go to SSK. It looks like Cartel Raider. You want to look at IREN? We can do that. All right. So we'll put IREN on the list and we'll cover that. All right. All right. Moving on to the next stock. We're going to go to SSTK, SSTK, which is Shutterstock. And this came up in the Discord. And somebody did say, hey, wouldn't this be a good idea? And let's get familiar with this business. I haven't analyzed Shutterstock before, so I want to take my time with it. So Shutterstock provides a platform to connect brands, businesses to high quality content in North America. The company offers image services consisting of photographs, vectors, illustrations. Okay. So let's take a look at their website. So if you want a stock of images, you go to these guys. Now, of course, we're in the AI era where, look at these, they have their own AI generator. How neat. That looks pretty darn good. So they have a lot of image libraries, and I get what they're doing. So let's say we're in football season. So let's just put in NFL football, see what stuff they've got. So you got all these images. You can, I think, get these images. You can buy them, or you can just go on Google Images and copy and paste. I don't know what the big benefit is if you buy them from these guys. So I see that. And of course, AI is going to generate images. That's kind of a big expectation on AI. All right. So they sell content, they sell images and so forth. It's a small cap. Over the 1 year, it's sold off. Probably the AI threat is what's causing the big sell-off. Big sell-off in their stock price, 29% over the 1 year. More of the same over the 5 year. It has not been fun. From 2021, this stock's really given up a lot of its value. It was $123 a share. Now it's 1/6 the size. That's a big haircut. So the market doesn't believe these guys are going to have a place in the future. And just high level, I kind of agree with the market. It's like, whoa, what's Shutterstock's place going to be in the future if you're going to have AI creating images? And I think images themselves are quite plentiful. It's not like, oh, we don't have enough pictures. We don't have enough pictures of Taylor Swift. No, we got plenty. or other types of topics. So let's keep looking, because maybe we're finding a diamond in the rough. So this is a $757 million market cap company with revenues of $1 billion. PE ratio this year is 11.77. Forward PE 4.81. They pay a big dividend. Interesting. Now, that dividend does not anywhere come close to the depreciation of the stock price. So interesting, they pay a dividend. And the reason why that dividend's gotten so high is because the stock price has dropped so much. So I don't really care about dividends. I'd rather see my stock go up 30% in value versus drop in value and give me a good dividend. Forget that. Now, what's surprising is the market's completely doubted this business, and they have been growing. Interesting. And especially trailing 12 months, their growth looks to be accelerating. The last quarter, they put up 21% growth. Interesting that they're growing. Why are they growing? They are generating a little bit of free cash flow. Looks like they burned some cash. Maybe they were building that AI, image creator, and they were burning a lot of cash trying to make that happen. We'll take a look at their financials. I'm curious to see, where are they growing? Why are they growing? That'd be interesting to find out. Now we look at their profit margin, not very profitable. Free cash flow margin hasn't always been all that great. All right. So let's look at their balance sheet, and then we'll look at their forecast. Then I want to look at their actual financials off their website. So they have a little bit of debt, 297 of debt, 116 of cash. So they have net debt of 180 million. Debt to EBITDA is fine. So they have a little bit of debt, but not enough to be concerned about that. So All right, so let me try to get to their financials because I'm really curious to see where are they growing. Is it that AI image generator, which might be quite interesting? So, we're going to go to Shutterstock. We're going to look at their financials. This is July 21st. So it looks like they're touting their AI services. There was a Shutterstock and Getty merger. Okay, so July 29th. Let me double check something. So that is for the second quarter. Okay. All right. So our complete suite of offerings, from creative content to custom creative solutions to AI model inputs to our GIPHY distribution. Okay. So revenues did go up nicely. Net income did expand nicely. So no, I'm sorry. Net income did not expand, but revenues did. Okay. No, net income was good. Sorry. Revenues did increase nicely. Net income also increased very nicely. Good reason why the growth was that they acquired a business in 2024 by the name of Envato. And that's what came in to increase the revenue. Okay. So they grew through acquisition. It's not bad, but it's not as good as organic growth. If I would have seen that, hey, we have this new product and it's AI product and it's growing like crazy, then I would have been really interested. But an acquisition is somewhat not as impressive. We look at the 6 months, okay, here's their revenue. The quarter, here's their revenue. Sales and marketing. Okay. So they have about 60% gross margins. Their marketing cost, sales and marketing cost, is about 21%. Okay. Product development is there. And then general administrative is about 20% of revenue. So it's just not really profitable. I think it's a pass for me. There's just not enough there. And what I feel they have good inventory of images, right? And they're not creating free cash flow. They are growing revenue, but that's because of the acquisition. Acquisitive growth is not as impressive as organic growth. If you have, for example, Microsoft grew Azure, their cloud business, in the last quarter reported by like 27% organically. That's impressive. Now, if they would have acquired a business and said, oh, yeah, we grew 27% because we acquired another business, not as impressive. And in this case here, most of its growth is because of that acquisition. It was a slow grower. I kind of give them a thumbs up for trying, but I don't think the market likes this stock. I don't think it's going to change its mind. I think the market believes AI is going to disrupt Shutterstock. There won't be a reason to have a company like Shutterstock in the future. And when I look at Shutterstock, I always think, man, when I go to Google, I can go to images and I can look at 100 images. I think I did NFL football as a search. I can get to all these images. I can copy and paste. So what's the big value add that Shutterstock brings to the table? Are their images a little better? Maybe. But you see that there's an alternative, and potentially an alternative that is free, that would be in competition with Shutterstock. And now you have all these AI companies that are doing image generation. You put in some variables. Hey, make me an image that looks like this, and it creates it, and you can keep prompting the AI app to keep changing it, and voila, it creates an image. So I think these guys are kind of caught on the outside looking in, unless they join the AI race and create a killer app, which I didn't see on their website. So for me, Shutterstock would be a pass. Thanks for asking. And I can't do evaluation because their free cash flows are so low. I couldn't get there. Their earnings per share might drive a nice discount according to analysts, but earnings per share is not as good as free cash. And the market's really doubting these guys. Free cash flow of $2 million. Last year was negative. So it's like, yeah, I couldn't get anywhere close to their current stock price. So that is Shutterstock. I'm glad we looked at it because it came up in the Discord. I think it's a communication services company, internet content and information, and good to catch it. It's less than $1 billion market cap. All right, next stock up. Good to see you, Anthony. Excellent. All right, so next one up is IREN. So IREN Limited operates in the vertically integrated data center business in Australia and Canada. The company owns and operates computing hardware as well as electrical infrastructure data centers. It also mines Bitcoin and scarce digital assets. So the crypto miners have figured out, hey, there's a lot of money to be made in AI services. Now, these guys have better linearity when it comes to their revenue, as opposed to Nebius. You had high revenues, went down substantially, and then they're picking them up again. So these guys, it looks like they're keeping their Bitcoin mining operation going. So these guys are a $501 million revenue business. They are growing nicely. They are profitable. Looks like about 68% gross margins. Okay. Net income is there for the trailing 12. Looks like they have a fiscal year that ends June 30th. So that's why it doesn't have trailing 12 months. They just ended their fiscal and they reported the full year. And on that full year, they made money. They did burn some cash. They've been burning cash each year. So these data centers are expensive. You're buying very expensive technologies, putting them into this data center, seeing if this technology, and then you're selling the capacity to customers who would then use that technology, do something with it, build a large language model, do agentic AI, do whatever they need to do with it. And they've been putting a lot of capital into that data center. Okay. But they're burning cash. This is negative cash flow. Their gross margins are good. This is why it's risky to just look at earnings per share. Is, hey, earnings per share might look good. Meanwhile, they're burning a lot of cash. Cash is king. Without cash, businesses cease to exist. All right. So They do have profits, but again, their cash flow burn is really, really high. And it's probably from all the GPUs they have to buy and the expensive technology they have to buy. We have 8 analysts covering them. The stock, most optimistic analyst is at $82 a share, but there are some analysts that are concerned. Like, hey, this is only worth 24. On average, it's priced 28% too high. The growth is incredible this year. This is the year we're in here. This is the year we just closed. This is the year we're in that will end June 30th, 2026. They're supposed to double in size. Very good. Actually, more than that. No, they're going to more than double in size, 135% growth. And then they're going to kind of flatten out. Now, if there's a slowdown in AI spend, these guys are going to feel it first. These small hyperscalers, they're going to feel it first. This is where there's going to be casualties, because if their customer stops and they have all this money invested in that data center, those are big losses waiting to happen. So if they grow at these rates, they're probably going to make some money. But again, I showed you AWS is 120 some odd billion in revenue. These guys are tiny compared to AWS. And AWS is getting bigger and bigger. They're going to be 200 billion in the next couple of years for their cloud business. And that's going to be like the AT&T Verizon example. And those guys are going to have a lot of gravity, and they're going to grab most of the bigger customers. They're a reliable company that's going to be there forever. So the earnings per share look pretty decent, and the PE is a little high, but the free cash flow is a different picture. The free cash flow does not look good. It's burning a lot of cash, and I'm curious to take a look at their actual financial statements so we can see if we can determine what they're spending money on that's driving that negative cash. So let's take a look. So this was May 1st. So I think their year ended June 30th. So they should have reported since then. Here it is. So the 10K. So every quarter, a company will report a 10Q, and then when they get done with the year, they report a 10K. That's what we're looking at, because their fiscal year ended June 30th. So we're in here. We're going to go to financial statements. I'd like to get my eyes on statement of cash flows. So here's the statement of cash flows. So they made some money. And overall, they have cash from operations. But this is where the money is being burned, is they're putting a lot of hardware in that data center. And they have to pay for it, right? They're going to buy all these GPUs and all this hardware. They have to fork over all this cash. And that's where it gets risky is, hey, if this equipment has a useful life of 5 years or 10 years, and it's basically used and customers pay them for it for the next 5 to 10 years, they're going to make money. Great. But there's also the chance of, what if the hardware isn't needed in a year or two? Then it's going to get really, really tough, because they're going to have idle hardware that isn't making money for them. But one thing I forgot to check is, do they carry debt? Well, we can check here. Let's go over the balance sheet. This is owner's equity. This is their income. So this is the breakout. So they're doing mostly Bitcoin mining right now. So Bitcoin mining represents most of their revenue, and AI cloud services represents a tiny bit of revenue. That's a surprise. And I think a lot of investors think this is an AI cloud business. Well, it kind of is, but not really. It's a Bitcoin mining company. This should be trading as a Bitcoin miner, not as an AI cloud business. See how small that number is? It's tiny. So that's why we look at the financials. All right, we're in the balance sheet. So we have $564 million of cash. Trying to see if they have any short-term investments. No, they do not. They have a lot of plant, property, and equipment. That's the stuff, the gear they've got in their data center. Almost $2 billion. And we'll look at their market cap. What's their market cap? So their market cap, 16 billion. That's pretty good. Just being in the right place at the right time, they've gotten a good market cap. All right, so now let's look at debt level. So here's the debt. They have $962 million of debt. Isn't too bad. So, okay. The market cap is 16 billion. They have $1 billion of debt. Not too bad. Now, these businesses have been going up like crazy. People think these guys are going to start printing money. And I don't think so. I don't think they're going to start printing money. I think they're doing okay. I think Bitcoin is going up in value. That's good. So if investors are investing thinking this is a Bitcoin miner, they're good at it, and they're going to make a lot of money doing Bitcoin. Okay, cool. I'm with you. But looking at their financials, they're mining about $500 million of Bitcoin per year. Well, then why is the business at that rate? You're paying 36 times sales of Bitcoin. That's really expensive. So interesting. I think this one here is, boy, that's an expensive stock. And they're burning a lot of cash. So I can't value the company on cash flows because I don't know when they're going to stop burning cash. It becomes risky because they're putting so much capital into that data center. If things stop or slow down with regards to AI stuff isn't as active as we thought it was going to be, this one's going to be a big, painful ride down for investors. So I'm not touching it. The reason that I'm an investor in AWS, which is Amazon, not AMS, AWS. Look at me. It's Sunday. All right. So this is Amazon, right? Of course, they have $670 billion of revenue. I showed earlier, like 121 billion of that is their cloud infrastructure business, which is somewhat comparable to IREN or Nebius. But what I like is, yeah, if AI creates a lot of demand, most definitely Amazon, AWS is going to get a lot of profit. So is Microsoft through Azure, and so is Google Cloud. But here, I get a diversified business. Amazon's not going to go broke in the next 10 years. If they overspend in the data center, they're going to take a hit. It's going to be some losses. But they have plenty of other revenues for them to continue on with very little disruption. I think the other pure plays, they just come with too much risk. And I think if the music stops on the AI build out, businesses are still going to be locked in with AWS because they have these big contracts. But the contracts with Nebius and CoreWeave and IREN and all these smaller players, those are the ones that are going to be sacrificed because they're like, hey, you know what? We already do a bunch of business with AWS or Azure or Google Cloud. We're just going to go ahead and consolidate with them. Sorry. And they walk away from the smaller players. So that's my story on these hyperscalers. It's been exciting to watch them, but we'll see. I think the market's really been amped up. Anything data center, boy, investors just investing in it blindly. And I have made some money on the data center for the last 3 years. I'm just, I want to make money every year. I like my portfolio to be, sustainable and being able to weather. If we are in an AI bubble and that bubble were to burst, I don't want to be, sitting there with 60% losses, 70% losses. I'd rather, okay, I took a haircut. I'm down 20% a year. Like back in 2022, the S&P was down like 25%. I was only down like 18% because I diversified well. So speaking of which, let's talk about the AI bubble. So the AI bubble, I've heard by some good names that, hey, we are in a bubble, right? Yeah, it's Gemini. And while Gemini works on this, so there's a significant debate, right? And and let me just throw out some names. First, Sam Altman, the CEO of OpenAI. About a month ago, he said we are in an AI bubble where you're seeing some businesses that really won't exist in a couple of years. Now, which ones are they? We don't know. I think that's why when I invest in AI related stocks, I'm careful because I did invest back in the .com bubble and the .com era. Some stocks that were like, for sure, that business is going to work, they've totally failed. And it took a long time to figure out which ones really were going to be the winners of the .com era. And I think it's going to take some time to figure out which ones really are going to be the AI companies that are left standing in 5 years or 10 years. And a lot of businesses are going to go away between now and then. And the owners of those stocks are really, really going to take a hit. So Sam Altman, a month ago, he said, hey, we're in an AI bubble. Next name, Jeff Bezos. He's probably the most recent of the really knowledgeable guys. Jeff Bezos is saying we are in an AI industrial bubble where it's just too easy for a couple guys with no real business to get a couple $1 billion of funding, and voila, they're off to the races, creating an AI company. He says it's just too exuberant. And he's a really knowledgeable guy. He created obviously one of the biggest businesses that now is one of the biggest players in the AI ecosystem with AWS. Paul Tudor Jones also said we're in a bubble, but he also said it could continue to go higher. And can't argue with that. Jamie Dimon worried we're in a stock market correction, but Jamie Dimon runs a big bank. I'm not going to give him a lot of credibility on he knows what the heck to talk about in tech. Another name, Orlando Bravo. He's a billionaire investor. He's clearly expressed we're in a bubble. We are in a bubble. And again, we can go higher, but just be aware if the bubble pops, we're going to see a very, very big fall for stocks, especially the ones that are completely tied to AI. And then Daniel Newman, another very successful investor, saying that, hey, we're in an AI bubble. So the comments continue to come. Speaking of comments, I think Anthony. So you read a stock market article saying that Trump is backing off the 100% threats. Well, that obviously make the markets go higher until the next tweet, right? It'd be nice to get just an agreement, because it's kind of wild to have days where the NASDAQ sells off 3.5%. So, but I'm going to take a look for that article there, since we have a little bit of time here. And if you have a link to that article, please share, Anthony. So this is the article that I thought was going to give us that. Trump is saying, hey, things are going to be fine. He's saying that things are going to be fine, but I'm not. Let's see if he's backing off the 100%. He may not follow through. Okay, so he may not follow through on the massive increases to China. Okay, these comments look good. So it looks like, the comment was made on Thursday night, Friday morning. Stock market just completely went nuts. And President Trump was like, whoa, hold on a second. Everybody just relax. We'll take those off the table if it's going to crash the market. So we'll see. We'll see how the market trades. Thanks for bringing that up. All right. So just a reminder, if you guys want to take a look at some stocks, put it in the chat. Members, it's included in your membership. Non-members, you could take a look at the very beginning of the stream, the what it takes to have a stock reviewed. All right. So earlier in the stream, we talked about what stocks are trending. And the first one we went over Nvidia, Amazon. Let's go over Amazon. Amazon did sell off quite a bit on Friday, down 5%. And I happen to think Amazon's a really good opportunity. I think Amazon is in a place where they're number one in e-commerce. Most definitely that's a business for the future. It just keeps getting, bigger and bigger and more convenient and faster to get deliveries. And Amazon's at the very front of that industry. No questions asked, right? They're number one by a huge margin. And they're also number one in data center, hyperscale services, number one. And talk about that's like super hot business right now. Well, Amazon has the biggest one. They're also good at, they have robotaxi, they have streaming, video streaming. They have a bunch of really nice businesses. They own Anthropic, or a portion of Anthropic. They're an early investor in that company. So Amazon's just loaded with really, really good value. But the stock has not been doing well this year. The market's like not convinced. And I think it's an opportunity. I like it when the market just doesn't believe in a business that I believe is incredibly valuable, because it gives me time to buy into the stock. And I've been buying shares into Amazon. The PE ratio is 33. Forward P is 31. Analysts think it is discounted, and it's a strong buy, discounted by 22%. This is a gigantic business growing at almost 11%. So when they grow by like $70 billion of top line revenue. That is incredible. They will be a $1 trillion revenue business in the next couple of years. And they create a lot of cash. They have been burning some of their cash in the data center. Gross margins of 49.6%. One thing that Amazon, just culturally for the time that they've been in the marketplace, is they will sacrifice their stock price so that they can become stronger. They can be better. They could treat their customer better, have a better relationship with their customer, just really obsess on that customer. And they want to build a stronger, better business for the future that's going to generate higher cash flows. And if it comes with short-term stock declines, they don't care. And frankly, I love that about them. That's the way businesses should be. Because if you don't get Amazon, that's great for me. Because I think I get Amazon. And I've been buying every week. I've been buying, especially on days when it goes down 5%. So Amazon, when I value them, there's a discount available. And this is one of the most important businesses that we have in the market. 46 analysts cover them. Some analysts believe this is a business that's going to keep going higher. The worst case scenario isn't too bad, 195. So the downside risk is pretty small. Look at this growth, 10% across the board. They will be knocking on the door of $1 trillion of revenue at the end of 2028. That is incredible. And their PE will drop, but I think their stock is going to rise. They'll always have a mid-30s PE because they're that important. And I think like investors woke up to Alphabet, Google this year, part of the year, market just didn't like Alphabet, Google. And then it said, whoa, that's a great business. Everybody started buying it. Voila. It's a good stock. It's performed well for 2025. I think the same thing's going to happen with Amazon. The market's going to wake up and go, oops, this stock's really desirable. And I'm going to check, but I'm pretty sure that our friends at Berkshire started to buy into Amazon. Let me show you my value of Amazon before I go there. So I think they're discounted by 16%. Not the biggest discount you've ever seen, but this is a really valuable business. And I'm now moving my discount rates down to 7.5 because interest rates are falling and they're going to fall over the next 3 years. So it's a good discount on Amazon. I want to own this really important business, top 3 most important businesses that we have in the stock market. I think it's Google, it's Amazon, and I don't know who number 3 is, but Google and Amazon are like super valuable, important, powerful companies. And I want to own both. So that is my story on Amazon. One thing I mentioned was I think some super investors own Amazon, but specifically, did Berkshire buy into Amazon? Berkshire's, one thing I like about them is they talk about their successes in a very humble way. And they also talk about, where they missed. And Mr. Munger, yeah, you hear this. So Charlie Munger, he said the biggest miss that he had of his career was not buying Amazon. And Berkshire owns Amazon. Not a big position, but I bet you they're going to keep adding shares. So where is Amazon? Here it is. So they own $2 billion of Amazon. I'm willing to bet you they're going to keep adding shares. And I'm going to keep adding shares. So Amazon, one of the trending stocks, and I think it's an opportunity knocking on my door. We'll see how that stock trades. Okay, so what is the next trending stock? AMD. having a really nice couple weeks. Of course, they had to give up 10% of their company to OpenAI. OpenAI committed to using their semiconductors in future data center operations, but AMD would have to give them 10% of their company. I mean, Advanced Micro Devices did the right thing and made that deal. Their stock price flourished, but again, 10% of the company. So that's kind of a big chunk of the company, and it's going to dilute shares to some extent. So that news really drove the stock. This stock is been doing well. Fundamentals look good, 27% growth. It had kind of a setback year in 2023. The company is profitable, generates cash flow. Not a lot of it, right? If I just naturally price this company, $3.5 billion in market cap, and I took it times 40, which would probably be the limit that I'd go on this stock, I'd get to 140 billion. These guys are above 300 billion in market cap. So I just can't get there with this cash flow. Nvidia is doing like $60 billion of cash flow. These guys are at 3.5 billion. It's like, guys, it's not a lot of cash flow. The gross margin is 50.99. Nvidia is at 70. And Broadcom is higher than that as well. So Broadcom generates a lot more cash, like 28 billion, $30 billion of cash. So AMD's just never been a high cash flow producing company, which is why I haven't really invested in them ever. And some analysts think $300 per share is where they should be. Some analysts had 120. It's priced about 6% too high. Revenue growth. They should be growing. Looks good. And their profitability is also going to expand. So AMD's, I've always invested in other semiconductor companies, but not this one because of their cash flow. Their cash flow just isn't very high. And I think that cash flow is why the stock hasn't really maintained a long, upward trend. The company that I did invest in that has better cash flows is Broadcom. I've since sold my shares, but when you look at their chart, it goes up and to the right. And you look at their cash flow forecast, their cash flow position, it's far better than AMD. 77% gross margins, much higher. $25 billion of cash flow. AMD's at 3.5 billion. It's like, geez, that's nowhere near what Broadcom and Nvidia do, which is why these stocks have really flourished. So that's why I look for cash. This one's at 24. Nvidia, look at their cash flow. 72 billion in the trailing 12 months, 60 billion last year. That's incredible. But it really shows how AMD is not even near their league. AMD's kind of minor leagues compared to Nvidia and Broadcom that are major league stocks. So AMD is one of the trending stocks. Interesting company. It's certainly flourished, and I'm happy for investors of AMD. They've made some money. Good for them. Good for them. All right, Tesla, Palantir. I think I'm going to stop there on the trending stocks. All right, guys. So I don't see any other request. So I think I'm going to end it there. I wanted to stream just a little bit because it has been kind of a spooky weekend around stocks. I mean, we're coming up on Halloween in a couple weeks, but it's kind of a spooky Friday with stocks selling off like they did. We're going to stream tomorrow morning, Daryl and I, and we can pick up at that time. If you have any stocks, show up and put them in the chat tomorrow morning. We can take a look at them. And if you're a member, go on the Discord if you want to keep talking stocks, and I could respond to you there. With that, everybody, Enjoy your evening. Let's see what this market's going to do this week. It's going to be an exciting week. And also on Tuesdays, when we start seeing some big earnings, we have JP Morgan, Johnson & Johnson, Wells Fargo, Goldman Sachs, BlackRock, Citigroup. So we have a lot of earnings on Tuesday. We have a lot of earnings on Wednesday. ASML, Semiconductor, Bank of America, Morgan Stanley, Abbott, Prologis. Thursday, we have TSM, another semiconductor stock, Charles Schwab, Bank of New York. So we have a lot of companies announcing, especially banks, and they will be talking about the economy. Friday, American Express and a bunch of other companies. So we have lots of earnings. And this is kind of the warm-up week, because the week that follows, man, put your seatbelt on, because you're going to need it. Netflix, General Electric, Coca-Cola. And then on Wednesday, Tesla, SAP, IBM, AT&T, Lam Research, GE Vernova, T-Mobile, Blackstone, Intel, Procter & Gamble. It just keeps going and going. We see these big companies that are going to announce. Visa, United Health, this one's going to be big for me. Microsoft, Alphabet, Meta on the same day. Man, it's going to be a huge day. October 29th. Woo, that's going to be huge. That is going to be a fun day. So this whole month, just be ready to see a lot of headlines around earnings. I think it's going to move the market. The stocks are going to move, and off of the expectations that are being announced. We'll see where this tariff issue lands, because, man, the market really moved on Friday. I think if you look at the Asia market, let's see if the Asia market's already accepting that situation. So this was from Friday. Now this is today's. So this is the Shanghai composite. It's down about 1%, not as bad as ours. Okay. And then this is Hong Kong. And it's not updating. Not updated. Why isn't it moving? It just was perfectly at zero. That's hard to believe. So Anthony, you want to see the discount on Amazon? 31%. I moved my discount rate to 7.5. I've been doing that. I've been moving my discounts by going from 8 to 7.5, because interest rates are moving down, and they're going to move down over the next 3 years. As we look at what the current Federal Reserve Board, including the chairman whose job or whose term ends in May, they have socialized that they're going to move interest rates down 3 times. So that's the beginning of the downward trajectory. And President Trump has already communicated he's going to fill the chairman role, the chairman of the Federal Reserve, with somebody who's committed to lowering interest rates. So I'm expecting that over the next 3 years, interest rates are going to really move down. So I'm moving my interest rates down on discounts. So Amazon is discounted by 31%, in my opinion. Remember, this is never financial advice. I'm just sharing my research with you. And that's my research on Amazon. So thanks for asking, Anthony. All right. So let's end it there, everybody. Have a great night. Thanks for tuning in. And let's see how this week goes. Have a good night.